Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan and Adrian, here with Adrian Nicholson. Adrian, how are you doing?
I'm doing fantastic, Roshan. Happy to be here. Looking forward to our topic today.
As am I. We are revisiting something we talked about earlier in the year, and we're going to um, have a little mini series here with two episodes focused on things we talked about earlier in the year. Eric, if you're listening, I'm sure you're very proud of us having a series, as he would always ask for those. Um, at the beginning of the year, we talked about a couple ideas. One were longer term treasuries. The other were small cap stocks, and they have not performed anywhere nearly in line with large caps, which have significantly outperformed them this year. So we want to revisit those topics and those ideas. As we always say, this is not investment advice. Please do your own research, your own homework, or contact your financial advisor if you have one. Reach out to myself or Adrian. We'd be happy to help. But once again, it's not investment advice. We're just exploring ideas to see if we can come up with things that can potentially be profitable for us, for our clients, and for our listeners. So, Adrian, I'll kick it off right now with this, starting with looking at treasuries, specifically long-term treasury bonds, which I'm looking at the year-to-date chart right now, and it is from a capital perspective, it's actually roughly flat on the year. It's actually down about 0.5% on the year. And with the 30-day SEC yield being a little over 4%, it means that if you bought this at the beginning of the year, have earned about 4% in income, and you have not gotten anything with your capital appreciation. When you compare that, and it's definitely not a fair comparison, comparing long-term treasuries with stocks, but when you just compare that to like what the S&P 500 has done year to date, being up around 18%, you'll see that why I said these bonds have significantly underperformed in the small caps as well. It's not that I expect you to, as I said, compare them to one another, but if they're components of your portfolio and you're like, well, this piece is up 18 and this piece hasn't made any money, what should I do about it? I think that's where we really want to start the conversation. Adrian, anything to add to that? Or if not, what are your thoughts on these long-term treasuries? What are you seeing, thinking with what's going on?
Yeah, I'd be happy to talk about that, Roshan. So I think the first thing that I would want to discuss is the correlation factor, because that's something that investors have just always monitored throughout history when it comes to portfolios. Depending on what your allocation is, you might be heavily weighted to stocks and underweighted to bonds, or it might be the opposite, where you're heavily weighted to bonds and underweight stocks. And the reason why that is a very basic allocation just to really pick on for this topic today is because of that correlation piece that I mentioned, where historically bonds and stocks have an inverse relationship. However, when it comes to long-term bonds and the S&P that you talked about, just the market, that correlation really hasn't been seen that often in recent history, where let's just say we have a day where stocks go down. Sometimes you might see bonds go down when historically bonds are supposed to do well when stocks aren't doing that. You're actually this year, you're starting to see that come back a little bit towards the end of the year. But again, it really hasn't been back to the degree that you see historically. And I think that's why, too, that's something people are looking at now, where especially with the talks of the Federal Reserve cutting rates right now, you have to go farther out to get more of that income, like you talked about with a 30-year Treasury, where a year, 2 years ago, you really did not have to go that far out when it comes to getting income on bonds. You just look at short-term bonds that pay you a lot, and that's a good position to be for your portfolio now, where the Fed talking about cutting rates, it's pushing investors farther out where they have to look at longer term bonds to get more income. So I think that's the two things I want to start and touch on. That inverse relationship between stocks and bonds, is that going to continue? Is that not? Because that's going to be a significant impact. And where you have to go to get that good yield with your bond fixed income part of your portfolio.
So, Adrian, you're talking about, just to break this down, how the yield curve has been inverted so people could go short term,
Yes.
correct? And now you're saying they're going to have to potentially shift to get a similar yield going longer term.
Yeah, exactly. And I know our topic is treasury bonds too, but that also might have people looking somewhere else, like corporate bonds as well. Just getting that yield and just trying to get the best thing that fits your portfolio is something where you have to look at the fixed income part of your portfolio if you have one and say, all right, what's going to be the best going forward based on the data, based on what's going on with the markets and the economy today.
Yeah, and I think what you're seeing is the bond markets are logical, and they're expecting, as a lot of us are, that the Fed will cut rates. So
Yes.
that's why short-term rates were better than long-term. No one wants to make a long-term commitment when they think the rate will be lower later if you're borrowing that money. So that's what the yield curve's indicating, and you're saying it's starting has have. And I have not looked at this in the last week or two, but are you already seeing that shift, or that going from inverted to flattening out, or getting back to a normal yield curve?
Yes, I mean, you really just take it and look at the investor because let's just take somebody, let's just say a good chunk of their investment right now or their cash is in a money market fund. And right now they're hearing, that time is probably coming to a close where you can get 5% on a money market fund or a CD, something like that, which is a really good rate that people haven't seen a couple of years back. And now with the expectations that that rate is coming down, again, it's like I talked about in the beginning, they're forced to maybe look and go somewhere else if they want to be able to compete with that yield or get that 5% where they can't keep their money in this safe location. They can, but they might not get the same yield. And that, in fact, causes that yield curve, like you talked about, Roshan, to change.
Yeah, yep, I can definitely see that. And I do try to gauge a little bit of what's going on by what are my clients seeing. I haven't gotten too many. I got one email from someone saying, hey, I read this article that said lock in long-term CD rates before September, and the article was saying there'll be a rate cut, so you should lock it in now. I have not actually compared the rates. I did read the article, and for that specific client, it didn't necessarily make too much sense. But
Mm-hmm.
where I was saying I hadn't looked at rates yet, my point was, oftentimes that's already baked in. So right now, if you're reading an article saying get it before September because the rates are cut, I imagine the rates have already been lowered in anticipation. The market's always adjust in anticipation of what's expected, which is a cut in September. Um, but Adrian, I do think you're right that because those shorter term rates are coming down. I definitely was looking at treasuries for a client a few months ago, and we were under 5, whereas we were getting over 5 just 6 months ago. I think we were getting over 5%. So you are seeing the markets get ready for that rate cut that's coming. Getting back to the treasuries, I was looking at more long-term treasuries here, and I sort of mapped it out into the bull case and the bear case of treasuries, and we can go through that. And if you don't mind, I'll start with the bear case, and then we'll move on to the bull case.
Yes, of course.
The one interesting thing I saw with the bear case was that the demand for treasuries have gone down. So the Fed has cut their treasury exposure by 24% through quantitative tightening. So the Fed was buying, for those who don't know, they were buying treasury bonds to help keep rates lower. When they stopped buying treasury bonds, and letting the ones they have roll off and mature, they have 24% less in exposure. When they have a treasury bond auction, you have prime dealers who are there, and they are required to submit a bid. They're 24 prime dealers. They're required to submit a bid, and they've increased their holdings by 250%. What that means is, and just going back on with prime dealers businesses, their job is essentially to create a market. They're market makers. They don't make their money by betting on the direction of the treasuries or anything like that. They typically make their money in between the bid ask spread. So they make a little bit on every transaction. They're not necessarily taking a position. So they've increased their exposure, as I said, by 251%. In a recent Treasury auction on the 10-year, they purchased almost 18% of the bonds issued, whereas in the past they were purchasing more like 15%. So you are seeing an uptick there, and to me, this is the bear case is for the treasuries, the long-term treasuries, is that they've been issuing a lot of debt, and there have been less buyers, and that would be, that would put downward pressure on the price. The yield would then be higher, but the price would be lower. So what I talked about earlier with the performance, saying this year if you owned a long-term treasury fund, you'd be down about 0.5% in capital. So that's the price is down about 0.5%, but you would have made a little bit over 4% in income. So you would have come positive. What this is saying is there's downward pressure theoretically on the price, so that when we have the rate cuts, the price will not appreciate as rapidly as it has historically.
Yeah, and
Any
that
thoughts
definitely
on
makes
that?
sense with the rate cut feature that you mentioned. And I guess the only thing that comes to mind with the bear case for long term treasury, I just have maybe two, and let me know if any of the research that you did lines up with it. I think a big factor in that would just be the economy, whether we have a soft or hard landing. I got to imagine that's one of the biggest driving factors when it comes to long term treasuries. For example, if we get bad data, if you see weaknesses in the labor market or whatever it is in productivity, and the economy starts slowing down, that will definitely have a negative impact on the equity market. And as we know, if people get scared in the equity markets, they'll move to bonds, safer investments, which could ultimately help out with the long-term treasury, especially if the Fed are reducing rates. However, it's the opposite, and the economy shows signs of strength. Data comes out, things are doing better, companies continue to come out with great earnings, beating and raising, then that could take even more money away from the treasury market that you were mentioning. There's one other thing I would want to comment on that, but do you want to touch on anything that I just said or move on to the second piece?
No, I agree with you, and that's actually part of the bull case. A
Mm-hmm.
weakening economy provides a tailwind for the long term
Mm-hmm. Mm-hmm.
treasuries. People want to buy treasuries then, which could potentially solve the bear case. If you have more
Yes.
buyers in there, demand's up on there, so then maybe that bear case is solved in that scenario. So we're seeing inflation pullback and jobs data worsen. Inflation fell below 3% for the first time since 2021, and if the Fed was raising rates to take control of inflation, well, now if they feel like they haven't gotten to their target yet, but if they feel like they're close enough and the economy is showing signs of weakness and they're going to cut rates. Actually, the Fed minutes came out recently, and there was talk in their meeting about a July rate cut, which didn't happen.
Mm-hmm.
So the markets are just at this point expecting a cut in September, and the rate cut, which was driven by a weakening economy and inflation coming more under control. All of that is the bull case for the treasuries, which Adrian
Mm-hmm.
is what you had pointed out.
Yeah, and then the second piece that I would touch on, I'm not sure how big of a factor this would be just competition between long-term treasuries and corporate bonds. I'm not sure if competition is the best word to use in this case, but like I said in my example in the beginning, if people want to look out farther on the yield curve or look out to longer bonds to get a better yield, and they're looking at a corporate bond that might provide better yield than a long-term treasury, because again, you're taking on that credit risk where you have long-term treasuries that are backed by the government versus a corporate bond that's only backed by a company. Typically, the government one is more secure. And that's why the corporate bond would have to offer more yield, because you're taking on that risk. Is that something that you've been looking at all, or is that something that may not be that big of a concern with the bear case for long-term treasuries? I definitely think that's also something too that investors are looking at as well. Is there more opportunity in the corporate bond space versus the long-term treasuries?
Yeah, and with what I've been looking at with treasuries, and the real data I'm seeing, that's primarily shorter term, right? So I have not looked at the longer term corporates, but I will say, the longer you go, uh, you're getting more opportunities in corporate versus the treasuries, and you would likely see that sensitivity as well with the rate cuts. I think you just see more of that. That's an interesting point you bring up, because I've not looked at what the long term corporate bond, um, what the impact of a rate cut for the longer term corporate bonds versus longer term treasuries. I'm actually going to look into that. You've given me some homework.
Yeah, and it just comes up with just our topic of discussion today. Just again, going back to what I mentioned about your allocation, and if you're heavily weighted in fixed income, then that's just something where you have to look at saying, do I need to diversify more? I mean, we talked about a few things here. We talked about long-term treasuries. We talked about corporate bonds, money market funds, CDs. There's a lot of way you can diversify that fixed income, where if you're wrong on one end, maybe that other place that you diversify could be more profitable and help out that part of your portfolio. Just something for our listeners and viewers to think about today, to moving forward with the rest of the year, with so much up in the air as far as rate cuts, the economic data, and just the second half of the year.
Yeah, and we, as we go over and talk about this and these bonds, and you're looking at different funds. As I'm trying to find, Adrian, some of what you just said. What
Mm-hmm.
you're looking for are the duration. So the longer the duration, theoretically, you'd have a greater impact. The rate cuts will have a greater impact.
Mm-hmm. Yeah, and that's just econ 101 right there. Depending on how much yield you are, and the maturity for your bond is very important on that fixed income part of your portfolio, because change rates might not have any impact, but depending on what your duration is, it can cause a lot of price swings on that fixed income part of your portfolio, when sometimes you maybe expect that to be a very stable part. So that's definitely something you have to look at, the duration part of your fixed income for your portfolio.
Yeah, yeah, that is for sure. I'm actually looking, the yield you're getting on the long-term treasury is, versus the long-term corporate, seems to be about a point higher. But I do think you're seeing a little bit more sensitivity to rates. As I said, that's good homework for me. And whenever we're doing something like this, I start having a list of additional homework and additional research. But that's one thing I'm going to spend some time on, Adrian. I appreciate it. Great idea.
Yeah, no, no problem at all. And I'm sure once you find the answer, we'll just talk about it on another future podcast episode as well, just see what you come up with. Because again, this is something that is going to be on investors' radars as well, with the Fed potentially cutting rates and seeing how that's going to continue, with the economic data that comes out as well, showing whether the economy is strengthening or weakening, is also going to play a big factor, where you really just can't ignore that fixed income part of your portfolio if you're heavily weighted in that area going forward.
Yeah, yeah, I completely agree. Now, with this, well, with what we were talking about today, as far as the treasuries themselves, and I was just saying, when I looked at the corporates, I'm seeing a higher yield. But on first glance, which this may not be accurate because I've not done a deep dive yet on this, but at first glance, it looks like you're seeing the treasuries be a little bit more sensitive to the rate cuts in terms of the volatility of the price. My initial thought is, I wonder if that's just a flock to safety. People worry about stocks, they go to treasury, so maybe there you get a little more there. But I'm not, as I said, I'm not sure, because I haven't looked deep into it. Do you have any thoughts on that thesis or hypothesis I've got, that the if the treasuries are showing a little bit more rate sensitivity beyond just the regular duration, that it would be a flock to quality? People are worried about markets, so they're going in stock markets, so they're going into treasuries.
Yeah, I mean, I can definitely see that, just especially where I don't think valuations have completely gotten out of hand in the equity markets. There are pockets where you can see that happen, where some people may want to look at making some changes, or, like you say, make that flock to more stable a more stable investment or something that provides better income until they think valuations go down to a good level where that might be another opportunity where they can get back in. Very difficult to do, but you have seen it happen before in the past where, you see signs of weaknesses in the economy or extremely high valuations. You might want to make that change just to get good yields and better rates while you can still get them at this time.
Yeah, yeah, and it it does seem like theoretically there'd be money rotating over, but when I look at that, I still think that when you're a long term investor, the stocks will outperform bonds in the long term, right? They do historically, and so I wonder if we will see a rotation or not into treasuries, or into long term treasuries in particular. On my bull case, I've got a couple other things I just want to review with you, Adrian, and just get your thoughts on this. The first is what we kind of talked about: a weakening economy provides a tailwind for long term treasuries. Um, and the next one is interesting because the SAM rule, as spelled SAHM rule, is a recession indicator. And here's what I found very interesting. I'd love your thoughts on it. This is created by an economist, Claudia Sam. I hope I'm pronouncing it right. And it says that if the 3 month average U.S. unemployment raises by half a percentage point from its 12-month low, you're in a recession. So this indicator says you're in a recession. What's interesting is the economist herself, Claudia Sam, came out and said that yes, this this indicator has been triggered. However, she doesn't believe a recession is imminent. And I'd love your thoughts on it. I have a few thoughts. What are your thoughts on that? Have you seen this Sam rule uh, headlines on this and recession at all?
No, I'm not familiar with it. I think the one that I'm most or know the most about is the NBER, and that's a recession indicator. That I mean, there's a chart on the line graph that you can look at just to show where historically what moments where we are in a recession, and it's a good indicator just to look at, just to familiarize yourself with these type of things that are out there. I mean, there are a lot of different indicators you can look at just to tell whether or not we are in a recession or not, or if there's one coming in the future. I mean, it's just very hard to predict. I mean, when it comes to economic indicators, it's definitely hard to just to rely on one. I'd love to hear what your thoughts are on it.
Yeah, I'll tell you, when I'm researching and looking, because I'm spending my time looking at individual companies, I try to look at that company's dynamics and not attempt to predict what's going to happen overall economically, recession, no recession. Now, when I am looking at these companies, I am taking into consideration, well, what if we have a recession? What's the risk? So, but going back to your question, not to avoid it, there are all these indicators out there, and we've had the inverted yield curve, which they say if you've got an inverted yield curve, there's a recession within 6 months to 24 months. And if I remember correctly, we're now in month 23 right now, in August of 2024. So uh, the thing with this SAM rule and the inverted yield curve as a predictor, um, and I always hate when it comes to investing or anything saying this time it's different. And I'm not saying that as a bullish case, like I don't think there's a recession. There could be, there may not be. But I view the inverted yield curve as being forced that way by the Treasury. So to me, it's a manufactured inverted yield curve versus an inverted yield curve that has happened through the natural economic environment. And I would say the same thing with this SAM rule and employment, right? The Fed wants employment to come down because that helps with lowering the inflation. So you increase unemployment and you lower inflation by doing so. So for this specific cycle we're in right now, business cycle that we're in, I think it has been manufactured versus the natural cycle of the economy leading us there. So I do think this situation may be different. All that being said, if there is a recession, I would not be shocked. If there is not a recession and we have a soft landing, that wouldn't shock me either. Right. And the same thing with employment. Yes, employment has This rule has been triggered, but I was not surprised when Claudia Sam came out herself and said she doesn't think there'll be a recession. It just because employment, this shift in employment has not been natural. And if you really think about it from a uh, larger perspective, we're only a few years out of a global pandemic that caused a lot of what we're dealing with now. So when you look at this economic data in decades or hundreds of years terms, et cetera, uh, I think we're very much going to look back at this and say COVID and the pandemic caused this, and here's how we reacted. And so you almost pull it out from history, like a baseball analogy with the era of steroids and juicing. There are many that say you should just take that era and remove those statistics like it didn't happen. I wonder if we're going to have some similar thoughts to where we say pull this out from any other analysis because this was not a standard time period.
Yeah, I definitely could see how it can just skew the data and the importance of looking on it by case basis. But I think what you mentioned too is something that investors really need to focus on, that employment too. I mean, that's just something that it ticked up higher, but that's something too where especially the Fed is just going to watch as well, just to see is that trend going to continue, where that typically is a little bit harder to manage compared to inflation, where they have a very strong tool, just raise interest rates a lot higher, just reduce as much as it can to restrict liquidity in the market, where unemployment might be a little bit more difficult.
Yeah, I mean, looking at this, it took so much longer, right? Where they have not raised rates now in what's it been like 9 months or so,
Mm-hmm.
and now you're starting to see maybe 7 months in, you're starting to see cracks in employment, right? Where so it does take time for. I'm sorry, 7 months from the last rate hike we're
Mm-hmm.
seeing it. So they've
Yes.
been raising for a while. One last point on this, Adrian, that I think that I saw that was interesting. It said without generative AI, earnings in the S&P would have actually declined year over year, and that even if there's no recession, you have higher comps for corporations to need to higher comps and for earnings that corporations will need to hit or outperform next year. And if they don't, that would lead to a recession. So I just thought this is part of, once again, the bull case for the treasuries, right? If you think there's a recession, you look at the long-term treasuries. So I thought that was interesting. It was basically saying even if there's no recession now, there will be next year because the comps are so high that you're going to have a decline in GDP. Once again, I don't necessarily agree or disagree. I just thought that was an interesting point worth sharing.
Yeah, I mean, it's going to be something that all investors are going to be looking at, seeing how much productivity is going to increase due to all the money that's being spent on AI this year. I mean, it's just so much money. And if they don't see those numbers, or if companies don't meet those expectations, I mean, now the biggest thing when companies come out with earnings, it doesn't matter if you come out with good earnings, you beat on revenue, but if you don't beat and raise or have a positive outlook, it's definitely something that can impact your stock in a negative way. So just seeing if that momentum continues is going to be something very crucial when it comes to the markets.
Yeah, I agree. So, as we said at the beginning, do your homework. So, in conclusion, with everything we've gone over, do your homework. There's one way you'd go if you think that we don't have a recession. Another way if you think there will be, and possibly another if you think there'll be a soft landing. And if you have a financial advisor, talk to them. If you need one, feel free to reach out to us, and we'd be happy to help. We'll be back next week with another great episode. Take control and achieve your goals.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.